Question 1. An individual purchasing a life insurance policy in Tennessee has a right to return the policy for a full refund within a specified period after delivery. This provision is known as the A. Reinstatement clause, B. Free look period, C. Grace period, D. Non-forfeiture option. Answer: B. Free look period. The free look period, often 10 days in Tennessee for new life insurance policies, allows the policy owner to review the contract after delivery and return it for a full refund of premiums paid if they decide it's not suitable. This crucial provision ensures consumers have adequate time to understand their purchase and are protected from impulsive decisions, offering a chance to cancel without penalty. For example, if a policy is delivered on June 1st, the insured typically has until June 11th to return it for a full refund. Always inform clients about this important right, as it builds trust and protects their financial interests. Question 2. If a policy owner in Tennessee decides to replace an existing life insurance policy with a new one, the producer is required to provide the applicant with a notice regarding replacement of life insurance, at which point: A. At policy delivery, B. Before the first premium is paid, C. At the time of application, D. Within 10 days of the application date. Answer: C. At the time of application. When replacing an existing life insurance policy, the producer must provide the applicant with a notice regarding replacement of life insurance at the time of application. This ensures that the policy owner is fully aware of the potential disadvantages of replacement, such as new contestable periods, higher premiums due to age, or lost benefits from the original policy. The purpose is to protect consumers from twisting, an unfair trade practice where producers induce policyholders to replace policies to their detriment. Always prioritize the client's best interest and ensure full disclosure when considering a replacement. Question 3. All of the following are considered unfair trade practices in Tennessee except: A. Twisting, B. Rebating, C. Defamation, D. Providing free financial planning services. Answer: D. Providing free financial planning services. Providing free financial planning services is generally not considered an unfair trade practice in Tennessee, as long as it doesn't involve undisclosed compensation or inducements linked to the purchase of insurance. Twisting, rebating, and defamation, however, are specifically prohibited practices. Twisting involves inducing a policyholder to lapse or surrender an existing policy for a new one to the insured's detriment. Rebating is offering a prospective client something of value not stated in the policy as an inducement to buy, and defamation involves making false statements about another insurer. Remember, ethical conduct and transparency are cornerstones of compliant insurance sales. Question 4. An insured in Tennessee allows their whole life policy to lapse. They opt for the reduced paid-up insurance non-forfeiture option. What will be the face amount of the new policy? A. The original face amount, but for a shorter term. B. A reduced face amount, for the same term as the original policy. C. The cash value of the original policy. D. The original face amount, with continued premium payments. Answer: B. A reduced face amount, for the same term as the original policy. The reduced paid-up insurance non-forfeiture option allows the policy owner to use the policy's cash value to purchase a new, fully paid-up whole-life policy with a smaller face amount. This new policy will have the same coverage duration as the original policy, typically until age 100 or death, but no further premium payments are required. For instance, if a $100,000 policy had sufficient cash value for a $30,000 paid-up policy, that $30,000 coverage would last for the insured's lifetime. This option is valuable for those who want to maintain some coverage without further financial commitment. Question 5. An insured, who is the policy owner, dies during the grace period of their life insurance policy in Tennessee without having paid the premium due. Which of the following statements is true regarding the policy's payout? A. The policy will lapse, and no benefits will be paid. B. The full death benefit will be paid, but any outstanding premium will be deducted. C. The policy will pay out a reduced amount, typically the cash value. D. The policy will be automatically reinstated if the beneficiary pays the premium. Answer: B. The full death benefit will be paid, but any outstanding premium will be deducted. In Tennessee, the grace period typically allows an insured 31 days after the premium due date to pay the premium without the policy lapsing. If the insured dies during this grace period, the policy is still in force, and the full death benefit will be paid to the beneficiary. However, the insurer will deduct any unpaid premiums from the death benefit amount before disbursing the funds. This provision ensures that beneficiaries are protected even if the premium payment is slightly delayed, avoiding a harsh outcome for a minor oversight. Question 6. Which type of life insurance policy offers a flexible premium and an adjustable death benefit, allowing the policy owner to increase or decrease coverage as needs change? A. Whole life. B. Term life. C. Universal life. D. Endowment policy. Answer: C. Universal life. Universal life insurance is characterized by its flexibility in both premiums and death benefits, making it highly adaptable to changing financial needs. Policy owners can adjust premium payments, within certain limits, and also increase or decrease the death benefit, although increasing it typically requires proof of insurability. This policy type also features a cash value component that grows on a tax-deferred basis, providing an investment element. Unlike whole life, which has fixed premiums, universal life offers significant control over policy structure, allowing for customized coverage. Question 7. According to Tennessee law, a life insurance policy's suicide clause generally states that if the insured commits suicide within a specified period after the policy's effective date, the insurer's liability is limited to A. The full death benefit. B. The cash value of the policy. C. The premiums paid, minus any outstanding loans. D. The premiums paid, without interest. Answer: C. The premiums paid, minus any outstanding loans. In Tennessee, a standard life insurance policy typically includes a suicide clause that limits the insurer's liability if the insured commits suicide within 2 years from the policy's issue date. If suicide occurs within this period, the insurer is generally only obligated to return the premiums paid, minus any outstanding policy loans. After 2 years, the suicide clause typically expires, and the full death benefit would be payable, regardless of the cause of death. This clause is designed to prevent individuals from purchasing life insurance with the intent of suicide. Question 8. The Tennessee Insurance Commissioner has the authority to do all of the following except A. Issue licenses to insurance producers. B. Approve insurance policy forms. C. Set premium rates for all insurance products. D. Conduct examinations of insurers operating in Tennessee. Answer: C. Set premium rates for all insurance products. While the Tennessee Insurance Commissioner has broad regulatory powers, setting premium rates for all insurance products is generally outside their direct authority. Insurers typically set their own rates based on actuarial data and market conditions, which then need to be filed with and approved by the Commissioner's office to ensure they are not excessive, inadequate, or unfairly discriminatory. The Commissioner's primary role includes issuing licenses, approving policy forms, and examining insurers to ensure compliance with state laws and protect consumers, but not dictating the actual pricing. Question 9. In Tennessee, a viatical settlement involves A. The insured borrowing money against their policy's cash value. B. A policy owner selling their life insurance policy to a third party for less than the death benefit but more than the cash value. C. An insurer paying out the death benefit in installments. D. The conversion of a term life policy to a whole life policy. Answer: B. A policy owner selling their life insurance policy to a third party for less than the death benefit but more than the cash value. A viatical settlement is a financial transaction where an insured individual, typically one with a terminal illness, sells their life insurance policy to a third-party company, the viatical settlement provider, for a lump sum. This sum is less than the policy's full death benefit but more than its cash surrender value. This option provides immediate liquidity for individuals who need funds for medical expenses or other needs, offering an alternative to surrendering the policy or taking a loan against it. Question 10. When an insurer uses an illustration in the sale of a life insurance policy in Tennessee, what must be included? A. A guarantee of future dividends and policy performance. B. A statement that the illustration is merely an estimate and not a guarantee. C. Only the guaranteed elements of the policy. D. A comparison to at least 3 other similar policies from different insurers. Answer: B. A statement that the illustration is merely an estimate and not a guarantee. When an insurer uses an illustration, which projects future policy values based on certain assumptions, Tennessee law requires a clear statement that the illustration is not a guarantee but merely an estimate. This is crucial because policy performance, especially for interest-sensitive products like universal life, can fluctuate based on investment returns, mortality, and expense charges, which are not guaranteed. The purpose is to prevent misrepresentation and ensure consumers understand that projected values are hypothetical, not promised. Question 11. An individual applies for a life insurance policy and pays the initial premium. The producer issues a conditional receipt. If the applicant dies before the policy is issued, under what condition would the death benefit likely be paid? A. Only if the policy was delivered to the applicant. B. Only if the applicant was insurable at the time of application according to the insurer's underwriting standards. C. Only if the medical exam was completed and approved. D. Only if the beneficiary files a claim within 30 days. Answer: B. Only if the applicant was insurable at the time of application according to the insurer's underwriting standards. A conditional receipt provides coverage as of the date of application or the date of the medical exam, whichever is later, provided the applicant meets the insurer's standard underwriting requirements. If the applicant dies before policy issue but was deemed insurable at the time of application, the death benefit would typically be paid. This receipt is designed to protect the applicant by ensuring continuous coverage from the application date, assuming all conditions are met, even if the policy has not yet been formally issued. Question 12. Which life insurance policy provision ensures that the policy owner can regain coverage after a policy has lapsed due to non-payment of premiums, typically requiring payment of back premiums and proof of insurability? A. Reinstatement provision. B. Non-forfeiture option. C. Automatic premium loan. D. Conversion privilege. Answer: A. Reinstatement provision. The reinstatement provision allows a lapsed life insurance policy to be put back in force, rather than requiring the purchase of an entirely new policy. To reinstate, the policy owner typically must pay all back premiums with interest, repay any outstanding loans with interest, and provide proof of insurability, often within a specified time frame, example 3 to 5 years from lapse. This provision is beneficial as it maintains the original policy's issue age and cash values, preventing the policy owner from needing to undergo a new application and underwriting process at a higher age. Question 13. An insured in Tennessee has an adjustable life insurance policy. Which of the following policy elements can they not change? A. The death benefit amount. B. The premium payment schedule. C. The insured individual. D. The policy's cash value accumulation rate. Answer: C. The insured individual. An adjustable life insurance policy offers significant flexibility, allowing the policy owner to change the death benefit amount, the premium payment schedule, and even the type of coverage, example from term to whole life. However, the insured individual, who is the person whose life is covered by the policy, cannot be changed. The policy is issued based on the specific insurability and characteristics of the original insured, and a different insured would require a completely new policy application. Question 14. What is the primary purpose of the entire contract clause in a life insurance policy in Tennessee? A. To allow the insurer to amend the policy terms at any time. B. To ensure that the policy and the application constitute the complete agreement between the policy owner and the insurer. C. To permit the policy owner to make changes to the policy without insurer approval. D. To define the beneficiaries and their rights. Answer: B. To ensure that the policy and the application constitute the complete agreement between the policy owner and the insurer. The entire contract clause states that the life insurance policy itself, along with the attached application, forms the complete and exclusive agreement between the policy owner and the insurer. This means that no other documents, oral statements, or external agreements can be considered part of the contract, preventing either party from introducing unwritten terms later. This protects both the insured, by preventing the insurer from denying claims based on unstated conditions, and the insurer, by preventing unapproved modifications. Question 15. All of the following are typically considered non-forfeiture options in a whole life insurance policy except A. Cash surrender value. B. Extended term option. C. Reduced paid-up insurance. D. Automatic premium loan. Answer: D. Automatic premium loan. The automatic premium loan, APL, is a policy provision, not a non-forfeiture option. APL is an optional rider that prevents a policy from lapsing due to unpaid premiums by automatically borrowing from the policy's cash value to pay the premium. Non-forfeiture options, such as cash surrender value, extended term, and reduced paid-up insurance, are choices available to the policy owner when a policy is surrendered or lapses, ensuring that some value is returned to the policy owner even if premiums cease. Question 16. In Tennessee, who is responsible for determining the suitability of a life insurance product for a prospective client? A. The insurance company. B. The Tennessee Department of Commerce and Insurance. C. The producer. D. The applicant's financial advisor. Answer: C. The producer. The insurance producer bears primary responsibility for determining the suitability of a life insurance product for a prospective client. This means understanding the client's financial situation, needs, and objectives, and then recommending a policy that aligns with those needs. Producers are obligated to avoid recommending products that are unnecessary, excessive, or otherwise unsuitable for the client, upholding ethical conduct and consumer protection standards. While the insurer also has suitability review processes, the producer's direct interaction with the client makes them the frontline for suitability. Question 17. Which of the following is typically not a characteristic of a qualified retirement plan in Tennessee? A. Employer contributions are tax-deductible. B. All distributions are tax-free. C. Contributions grow tax-deferred. D. Must comply with ERISA regulations. Answer: B. All distributions are tax-free. Qualified retirement plans, such as 401(k), S and IRAs, are characterized by tax-deductible contributions, for traditional plans, tax-deferred growth of earnings, and compliance with ERISA, Employee Retirement Income Security Act, for employer-sponsored plans. However, distributions from traditional qualified plans are generally taxable income upon withdrawal, typically at retirement. Only specific types of plans like Roth IRAs or Roth 401(k) offer tax-free distributions in retirement, provided certain conditions are met. Question 18. An individual wants to purchase a single premium immediate annuity, SPIA, in Tennessee. When will the annuity payments begin? A. After a specified accumulation period. B. within one payment period after the purchase. C. Upon the annuitant reaching retirement age. D. At the end of the first year following purchase. Answer: B. Within one payment period after the purchase. A single premium immediate annuity, SPIA, is designed for immediate income distribution. As the name suggests, it is purchased with a single lump sum, and annuity payments begin almost immediately, typically within one payment period, example 1 month, 1 quarter, after the purchase. There is no accumulation phase with an SPIA. Its sole purpose is to convert a lump sum into a guaranteed income stream, making it suitable for retirees who need income right away. Question 19. If a life insurance policy in Tennessee has an accidental death benefit rider, how much would typically be paid if the insured dies as a result of an accident? A. The policy's cash value plus the rider amount. B. The full death benefit plus an additional amount, often double or triple the face amount. C. A reduced death benefit. D. Only the premiums paid. Answer: B. The full death benefit plus an additional amount, often double or triple the face amount. An accidental death benefit, ADB, rider, also known as double indemnity or triple indemnity, provides an additional payout if the insured's death is directly caused by an accident, as defined in the policy. This means the beneficiary would receive the policy's standard death benefit plus an extra amount, which is often equal to the policy's face amount, doubling the payout, or even 2 or 3 times the face amount. This rider is designed to provide extra financial protection specifically for unforeseen and accidental fatalities. Question 20. Which of the following statements regarding group life insurance in Tennessee is generally true? A. Individual underwriting is required for all participants. B. Coverage is typically less expensive than individual policies. C. Employees own their individual certificates. D. Premiums are always paid solely by the employer. Answer: B. Coverage is typically less expensive than individual policies. Group life insurance is generally less expensive per unit of coverage than individual policies because it involves a larger pool of insureds, allowing for lower administrative costs and a broader spread of risk. While the master policy is owned by the employer or group sponsor, employees typically receive a certificate of insurance as proof of coverage. Group life usually offers limited or no individual underwriting, often requiring only that an individual be actively at work to be covered, simplifying enrollment compared to individual policies. Question 21. Which of the following is an example of an illegal inducement to purchase life insurance in Tennessee? A. Providing a potential client with a free financial needs analysis. B. Offering a prospective insured a portion of the producer's commission. C. Explaining the tax advantages of life insurance. D. Offering a promotional item valued at less than $25. Answer: B. Offering a prospective insured a portion of the producer's commission. Offering a prospective insured a portion of the producer's commission, known as rebating, is an illegal inducement to purchase insurance in Tennessee. This practice is prohibited because it can lead to unfair competition, obscure the true cost of insurance, and potentially compromise the producer's objectivity in recommending suitable products. While promotional items of nominal value, example under $25, or free financial analyses are generally permissible, sharing commissions is explicitly outlawed. Question 22. In Tennessee, a common exclusion in a life insurance policy that states the policy will not pay out if the insured dies while engaging in certain high-risk activities, such as aviation, unless as a fare-paying passenger, is known as the A. Hazard Clause. B. Aviation exclusion. C. War exclusion. D. Non-occupational clause. Answer: B. Aviation exclusion. The aviation exclusion is a common provision in life insurance policies that states the policy will not pay a death benefit if the insured dies as a result of specific aviation activities, such as piloting a private plane or engaging in stunt flying. This exclusion typically does not apply to fare-paying passengers on commercial flights, as that is considered a lower risk. Such exclusions are included to manage the insurer's risk exposure to exceptionally hazardous activities. Question 23. Under what circumstances can a beneficiary designation be changed in a life insurance policy in Tennessee? A. Only if the beneficiary gives written consent. B. Only if the policy owner designates an irrevocable beneficiary. C. If the policy owner has designated a revocable beneficiary. D. If the original beneficiary dies. Answer: C. If the policy owner has designated a revocable beneficiary. A beneficiary designation can be changed by the policy owner if they have designated a revocable beneficiary. A revocable beneficiary means the policy owner retains the right to change the beneficiary at any time without the beneficiary's consent. If an irrevocable beneficiary is designated, the policy owner generally cannot change the beneficiary without the irrevocable beneficiary's written consent, as the irrevocable beneficiary has a vested interest in the policy. Question 24. A producer completing an application for life insurance in Tennessee must ensure that all blank spaces are completed. If an applicant marks a blank space with not applicable, how should the producer handle this? A. Leave it as not applicable if truly not applicable. B. Cross out not applicable and write none instead. C. Have the applicant initial the not applicable notation. D. Require the applicant to provide a specific response for every blank. Answer: C. Have the applicant initial the not applicable notation. When an applicant marks a blank space with not applicable on a life insurance application, the producer should have the applicant initial this notation. This practice confirms that the applicant specifically chose to mark it as not applicable, rather than the producer leaving it blank or altering it. Ensuring all blanks are completed or clearly marked and initialed by the applicant minimizes ambiguity and potential errors or omissions that could later lead to policy issues or claims disputes. Question 25. All of the following are settlement options available for life insurance policy proceeds in Tennessee except A. Lump sum. B. Fixed period installments. C. Cash value loan. D. Interest only. Answer: C. Cash value loan. A cash value loan is a policy feature that allows the policy owner to borrow against the accumulated cash value of a permanent life insurance policy while the insured is still alive. It is not a settlement option for death benefit proceeds. Settlement options, such as lump sum, fixed period installments, and interest only, are ways the beneficiary can receive the death benefit payout after the insured's death. These options allow beneficiaries to choose how they prefer to receive the funds, whether as a single payment or over time.